Okay, let's get to the top picks. Colliers, a real estate play.
Yes. I mean, at the beginning of the show, we talked about rising interest rates are hurting stocks and bonds and real estate activity. And so Colliers, being in the real estate sector, has seen its stock come off as well. Now, there's a couple different ways to play this whole interest rate hike. And on the anticipation that if rates come down, securities are going to go up. I mean, you can buy bonds and different ways to do it. But another way to do it is to find companies that are taking advantage of the downturn in the real estate market, for example. And that's what Colliers is. Now, Jay Hennick, the CEO, recently said that our shareholders know that Colliers seizes its greatest opportunities during challenging times, right? And they believe that high interest rates and allows them to complete acquisitions and retain talent that they could otherwise be more difficult to do. And these are counter-cyclical companies, like Murray Edwards, CNQ, right? Bruce Flatt at Brookfield, to take advantage of these downturns. So there's an opportunity there for Colliers. And also the brokerage business, the way the stock has come off so much that the brokerage business is basically being ascribed little to no value. So you get that as well.
Okay. So Colliers, that's interesting. Yeah, at a time of pessimism for real estate, time to get into it.
That's right. Yeah, and the management team has had an incredible track record over the years as well.
Royal Bank of Canada is your next idea.
Yes, Royal Bank of Canada. I mean, this is all the banks are down, but it's very rare where you can buy a Royal Bank at less than 10 times earnings, which is where it's at right now. And another way to look at Royal Bank is that their price-to-book ratio. Their price-to-book ratio right now is just over 1.5. And the last time it was at 1.5 was during the early period of the pandemic, right? And I would argue that things aren't as bad as the early months of the pandemic.
No, it is still up from the pandemic.
It is up because the price to book is a multiple of the book value.
Right.
And the book value of Royal Bank of Canada has increased for the 29 consecutive years in a row. And so over the last 10 years, the price to book ratio has averaged 1.8. And so if it returns back from a 1.5-ish to a 1.8, you're looking at close to about 20% return. And of course, as the book value increases every year, if it gets back to that 1.8 ratio on a higher book value, you're going to even get more than the 20% return, and you add on the dividend yield on top of that.
And then finally, Delta Airlines. You've touched on this theme already. You think there's too much pessimism in the airline stocks right now?
There is a lot of pessimism. I mean, the fact that the airline stocks are trading back to 2020 when their planes were 90%, well, travel was down 90%.
Right.
They were losing billions. And the situation's much better today, and yet the airline stocks are not reflecting that. And so there's a number of airline stocks you can probably buy, but we're picking Delta. It is considered the best managed airline in North America. It's ranked by the Wall Street Journal as #1 airline for 5 of the last 6 years. Condé Nast Traveler, the Reader's Choice, is ranked at #1. And it's got the highest proportion of strong buy and buy recommendations among analysts over Air Canada, United, and American Airlines. And it's trading at about 5.5 times this year's earnings and 5 times next year's earnings.
I was reading Consumer Reports yesterday. I know I need to get out more, but I can't remember. They were ranking airlines, I think, by customers. I can't remember where Delta was, but Hawaiian Airlines ranked very high. I don't know if you've ever flown Hawaiian.
It's been a while.
Yes.
But I suspect they could do a pretty good job because they don't have much competition in there, and the travel, the tourism travel to that state is obviously very high.
CIBC's out with an interesting note today that if maybe we could put up Air Canada over the past 3 or 5 years, that Air Canada, in the Canadian airline industry, the capacity is still well down from 2019, but demand has come roaring back. So they're obviously making more money. They can charge more if they're keeping capacity low, but the stock hasn't done much.
Oh, I know. And actually, when Air Canada announced their most recent results, they announced that they had I think it was like $4.5 billion worth of ticket sales, up from 2.9 in the third quarter of 2019. And so their advanced ticket sales are up big time compared to 2019.
But they're not flying any more planes.
And because the capacity is their capacity is tight. And so their planes are fuller. The ticket prices are high. They're making money, and yet Air Canada's stock is very similar back to where it was in 2020. So it's another attractive one as well.
Yeah, they're just keeping supply tight in the airline industry. Yeah, smart. Well, the car companies have been doing that to some extent as well. I know they had supply chains and everything, but
yeah, actually, you're right. And I mean, the bulls on Ford, they were hoping that the strike would be more severe.
Yeah.
To bring inventory levels down in the industry down to like maybe 1 million units, because the inventory is about 1.5 to 2 million units. And if you have a really severe strike and you bring the units down to 1 million, then you have a very bullish thesis on Ford and GM. But they actually settled the strike a little sooner than those people thought.
Yeah, that's what you want, to be able to charge the customer what you want. Yeah, yeah. We'd better leave it there. Teal, thank you very much indeed.
All right, thanks for having me.
Teal Lind has been our guest on Market Call. Thank you very much indeed for watching. John Zechner is up tomorrow. John's first idea is PayPal Holdings, PYPL.
Yeah, I feel like I might regret this a year from now when I come back to defend it or something like that, because I talked earlier before about don't buy value in technology, and that's what this is. Stock has come down a long way. It's trading around right now probably about 11 times forward earnings, and yeah, the payment space seems like a bit of a risk. And these guys, it feels like they've lost some growth and some market share and all of that. And what's Apple Pay going to do and what dominate? But I look at they've got Venmo. They've obviously got the PayPal moniker themselves. They're on Amazon now as a payment system. And look where the stock has come down pretty dramatically. They're generating free cash flow. They've got new management in place that it seems a little more oriented towards profitability, which should help. And like I say, trading at 11 times earnings, I thought, man, it just seems to stick out as it's got all this potential of the turnaround. And will it happen? I don't know. Like I say, the payment space is a tough one to figure out, because where is it? It's changing so dramatically. But part of it is having a name brand, and they've got the name brand, and they got the off-name brands as well. But certainly Venmo is doing well, like I say, on Amazon, and everybody knows the PayPal moniker. So.
Okay. Is Venmo part of PayPal?
Yeah,
I didn't even know
it's
that.
one of their offerings. Yeah, they got a number of different offerings, and they white label it too. They may do it for independent retailers as well as do payment system where they provide it, under that retailer's whatever sort of moniker, however they want to do it. So.
Pembina Pipeline would be a favorite in energy.
Yeah, and we talked a little about Enbridge earlier, but and what I'm looking for in this market is defensibility, high dividend yield, lower valuations, and less economic sensitivity, and certainly to commodity prices. Pembina seems to tick off all the boxes. I think it's 6.5% well-covered yield. The earnings came out last week; they were a beat on the EBIT side, and so they're trading under 10 times operating cash flow right now. Probably fewer warts than some of the issues you see with TC Energy, obviously with Keystone, some of their other projects as well. Enbridge, we mentioned they're sort of swallowing the acquisition in the U.S. right now, and they've had problems with Line 3 and Line 5, so there are issues there. Pembina doesn't have that. And on top of all of that, I think we know the federal government wants to get out of their investment in Trans Mountain Pipeline at a point.
Yeah.
I think Pembina is one of these guys who are sitting on the sidelines and will probably be in line to buy a piece of that. And I think it'll probably, the government's probably going to sell it at a bit of a loss. And I think whoever buys in, may do well with that. So I think they, down the road will be looking at maybe picking up a piece of a divestment of Trans Mountain. But, why do it now? Let them sort of get it up and running and take all the operational risk first.
Yeah, exactly. I think Pembina has said we're interested, but we want to see how Trans Mountain works out.
Yeah, exactly.
Martin Rea would be your pick, partly in auto parts.
Yeah, and we talked about Magna earlier and some cyclical stocks. I said, we know what the issues are facing the industry, right? Slowdown in auto sales, overall slowdown in economic growth is going to be a headwind generally. But when you get companies trading at 3 to 4 times operating cash flow and about 8 to 9 times forward earnings, you know what? You've baked in a lot of pessimistic assumptions into your outlook. So, I think these guys could have a miss and probably the stock wouldn't be hurt that badly. But more importantly, on Martin Rea's side, they're winning new platforms. They're huge into the lightweighting of vehicles, a lot more aluminum parts, going forward as well. So, and as I mentioned with Magna, the same thing is they're positioned well for both the ICE, like the internal combustion engine, as well as electric vehicle, because outside of, the drivetrain, you've basically got 80% crossover of parts from those kinds of vehicles. So whatever you have for, ICE, you can probably make the same components for electric vehicles as well. So they should be able to transition the plants to contracts there as well and be able to continue the growth. So it was a nice way of playing the migration from internal combustion to electric vehicles without taking that product risk that you take as much with, an equipment manufacturer, an OEM like, GM or Ford or Stellantis.
And it looks like the auto companies are having second thoughts about electric vehicles in terms of slowing down some of their growth.
Well, they really are. I mean, they've all spent a lot there. Demand hasn't been as strong. And I think the problem is the infrastructure, quite honestly. I mean, you look at it, a lot of people, where am I going to, plug the thing in if I'm traveling on the road? It's great, am I going to have a 220-volt charger in the garage or something like that to plug it in every night? But it's, it's not, it's like the cell phones or something like that. You got to be charging these things on the go.
Yeah.
And, where are the charging stations? They're certainly not out there enough to satisfy needs, and you've got to have high-speed chargers, so you're not going to sit there, I'm going to pull over for an hour and recharge my vehicle. So I think that's a bit of an issue. And the governments have been their own worst enemy here. When the Canadian government says, oh, we're going to be 100% electric vehicles by 2030 or 35, whatever. We're not. It's going to, these migrations always take longer than people expect. In the meantime, the industry's overbuilt. China's been a massive player there as well, and they've been building lower cost vehicles for the, for the mass market as well. And the price, the pricing of the electric vehicles is obviously a huge issue as well. I mean, for the higher end, it's fine. People, we can play it up, but it's not for everybody. So.
Yeah. The Wall Street Journal, I think it's the Wall Street Journal, has a story today saying China's going to be very hard to unseat from battery dominance.
Absolutely. So.
John, thank you very much.
All right, Andy, always a pleasure.
Let's get to Jamie's top picks. Aritzia, of course, this one is down a lot, isn't it?
Yeah, it's not been a good year for Aritzia, but therein lies the opportunity. So, I mean, this is a name that we've owned over the past 6-7 years since we launched our fund. And so what's happened with Aritzia and why do we think this is the right time to get in? After explosive sales growth through the pandemic, I think 1 year ago was probably the best 5-year performer on the TSX. And now that's all kind of unraveled in the last 12 months. And we think this is a great time to get back into this name. So, I mean, first off, on the sales side, after big sales growth, as we said, sales have just kind of flatlined. Investors in the investment community expected sales would continue to grow slowly, but given the weak consumer in Canada and the U.S., as well as just a lack of new styles, some fashion risk that you get with these names sometimes, the sales just haven't been as strong as the market was looking for. They also haven't really opened too many locations in the last year, and that's just a timing issue. And then the second issue this year, there was a margin problem with their supply chain or their distribution facility that they were building in the Toronto area. Went a little bit over budget, took a little bit longer to come on, and that came at a time where they were already over inventoried. So you had this hurricane of events that all happened this year, and the market really punished the stock. But now they just reported a month ago. It seems like all these are issues that were in the past, not in the future. The stock's trading at 13 times the next 12 months earnings, so that's a very, very attractive PE ratio. And now we're moving into a period where we are expecting the U.S. consumer and even Canadian consumer to be stronger when we look out 6 to 12 months than where they are today. Aritzia is going to increase their square footage by 35%. So the store unit growth is coming back. They're building bigger stores. An interesting example is in New York City. They're moving from one location to another. The store is going to be twice as large, but because of the deal they were able to get on the rent, the rent's only going to be about the rent's going to be lower than what they were paying in the smaller store. So lots of opportunities to grow, and I think this company is it's going to go back into growth mode. The multiple is going to re-rate. The margins are going to come back, and
we're very
the share
tight.
price is really attractive right here.
I'm sorry, Jamie. We're tight for time. Exchange Income. Why do you like this one?
Yeah, sure. So Exchange Income is a leader in the Canadian aerospace sector and also has some interesting manufacturing assets. As far as the aerospace side, they operate in niche markets, so there's not as much competition. So they operate in some northern communities. They have medevac. They also have pilot schools. They have government contracts for maritime surveillance. So an array of assets that all sort of come together to create this great business. And then the manufacturing side, again, some niche businesses. it yields about, I think, 6%. We think that yield's going to continue to grow. And when these new contracts that they have with the government for, this medevac and maritime surveillance come in 2025, we're going to see huge revenue and profit growth for Exchange.
Okay, and then finally, Aon PLC, AON in New York. What do they do? Remind us, Jamie.
Yeah, so Aon's insurance brokerage, risk management, employee benefits, compensation consulting. So an array of risk management and HR, human resources consulting services. And Aon's really just one of those steady Eddie companies that has a high recurring revenue. Most of their customers come back year after year for their products and services. It's very high margin when they add new services to an existing customer, so they might cross-sell products. That helps out the margins. And then there isn't a lot of capital expenditures, so that growing free cash flow just gets added back into to buying back shares, buying back stock. And they're really just going to keep the same playbook that they've used over the last decade. So for a lower risk, kind of set it and forget it company, we think Aon's a great fit for that.
Jamie, we better leave it there. Thank you very much indeed.
About
we
Die
have
Hard.
a recommendation here, an idea from Paul. They're not recommendations so much as just ideas that people may want to explore. First idea, TELUS bonds with a maturity date of 2025. So you were talking earlier.
So this is the heart of what I was talking about.
Yeah.
Back in January and February, we looked at the curve, the yield curve, and we really thought that the 2-year area was rifled with really good yielding bonds and investment grade bonds. So TELUS is one of them we bought. We also bought TMX Group and Couche-Tard, it was a bond. And they all were yielding at the time around 5.5 to 6. And we think for fixed income and for very little volatility, to get a 6% yield is pretty good in this market, because we think the equity market is going to struggle over the next year or two. We think it's higher for longer. So if you think higher for longer, it's going to be hard for the equity market to rally. So we think by being in these type of bonds, if you don't want to take the risk in the stock market, it's not a bad place to be. Where 3 years ago, this bond was yielding 2-3%, right? Because of rates were down so low.
So, and TELUS's credit rating?
It's a triple B.
Triple B, yeah.
Which is defined as anything triple B low and higher is defined as investment grade bonds in our world.
Yeah.
And so there's many of them. Now, the only issue is if you're going to buy these bonds, you got to be careful of your advisor not, it's not transparent. Like, it's a secondary market.
The price you pay.
Yeah, so be very careful on that.
Yeah. Alimentation Couche-Tard, this stock hitting record highs, but you see upside.
We've owned it, sold it, owned it, and we don't know if we'll ever sell it again. Now, that's kind of silly to say that, but it's one of these stocks that are just best in class, amazing acquirers, great dynamics on the balance sheet, free cash flow. And they're even saying, which is the street doesn't even believe, they think that by 2028, they're going to get to 10 billion of EBITDA, which and the margins are hovering around 33% gross margins. So we think this is, and on top of that, as we know, the what is it called? Circle, the convenience store
Circle
effect.
K, yeah.
Circle K. In a recessionary economy, and even in the pandemic, when people had to fill gas, and it's just a great business because you're dealing with very quick sales. And they're incredible at, this has become almost a tech company in the sense that if you have so many stores globally, they're global, right?
Yeah.
And they're acquiring, you have to have the technology to talk to all these stores. So I think they're doing a very good job of creating cost savings. I wouldn't be surprised if AI helps them a bit. I don't pretend to know. I'm going to know as much as you on AI, but I think this would be something where it's going to only help their margins. And the only weakness was fuel sales do impact them, and they were lower. So that impacted them. But they've generally done so well, and it's just this slow company, slow price that just keeps gravitating upward, and that's what you kind of like to see. You don't want all this volatility coming from type of story like that, so we like that.
It's interesting how they put their toe into the cannabis market, teaming up with Fire and Flower.
Yeah, and they're a benefactor of all the munchies that you have to.
Right.
So after you smoke up, so.
Oh, Cisco Gold royalties.
I don't usually
OR.
talk about gold company. That's more the domain of my partner, Bill Harris.
Sure.
But I think it's more of a macro. We are fully invested in our gold spot. Like we have a certain amount that we want to invest in gold. And we finally think it's, first of all, they get royalties from a lot of North American mines. So you're not dealing with Panama and you're not dealing with South America and all that. Secondly, they get royalties. They're not the end. They just provide financing. We think gold will start finally outperforming consistently for the next couple of years because everything's in the right place now. You're going to eventually have a US dollar that trails down because they're going to have to lower rates eventually. They're not hiking as aggressively. What got in the way of the gold market is that US dollar was so strong over the last 24 months. Now it's coming off. So we think from a gold position, instead of being an operator that has to deal with higher costs, we really like the royalty space because you don't have to deal with the high. They get paid regardless, right?
Oh, for sure.
So in the end, we think this is a good exposure and they're a good company and it's no more than that.
Okay. Well, let's leave it there, Paul.
Okay.
Covered loads of ground. Thank you very much indeed.
My pleasure as always.
First idea here is the Consumer Staples Sector Spider Fund, XLP. Why do you like the look of this chart?
Well, first of all, I'll mention that, earlier in the show we mentioned, well, we rotated at Value Trend. We moved out of Johnson & Johnson and we moved into something else. And I said, I'll tell you later in the show this is what we bought. If we look at, I'm actually going to ask for a longer term chart. So if we could go back like 5 or 6 years.
I think we're stuck with that for now anyway, the 1 year.
Okay. All right. So, well, if we did go back in time, then you would see that we're actually bouncing off of a base that it has hit many, many times. You can see the lid here. It for the most part of 2023, it didn't reach the $66, $67 point that it's bouncing off of right now, but it has multiple times in the past couple of years. So we're trying to buy off of that base, and you can see the recent cluster, there was like kind of a couple bottoms, a little bit of a, on the daily chart, and then a bit of a breakout. So we think that the staples are going to head back closer to their old high levels, which, by the way, is a major resistance level. You don't want to hold the staples past that level, but we think it's a pretty easy trade. Also, if we are entering into a softer economy / recession, guess what? Staples are an outperformer. So we really like the sector. In fact, we have a full position. We leg into things, and we've been legging in. Like we really like the position.
Oh, okay. Your next idea is in platinum, physical platinum, PPLT, an ETF tracking that.
Yeah. So we have 2 accounts. We have the account that I'm usually talking to people about is on this show is our equity platform, which is a very low volatility platform. It's actually been outperforming the market the past couple of years because of our low volatility. We hold a lot of cash at times when markets are going down. We have another platform called our aggressive strategy, and we do things for quick flips and quick moves, and it's very different than the regular equity platform. And so with platinum, again, if we looked at a long-term trend, you'd see that it's got a level of support. We're hoping it'll bounce off, and that we'll get some. It's a short-term trade. We might go from we just recently bought it like this week. And we hope to see $90 and then get out, because a move from 80 to 90 is not bad. So this is a trade. This is not for conservative, like safe money investors. This is a trade with a little bit more aggressive look.
And then finally, Enbridge. Now, this one has been out of favor along with a lot of other high yield stocks.
Yeah, and it's the same logic here. Enbridge has, again, if we go back, sorry, I've got all my old squiggles here. So we can go back, and actually, if you do this, do the chart going, way back, you'd see that the stock. Actually, I wouldn't mind again a longer chart on this.
Should we try a 10-year chart, or is that going too far?
Yeah, or well, at least a 5.
Okay.
And you'll see sort of a, there we go. Okay, so you can see there's been a bit of a pattern, and yes, if you went back like 6 or 7 years, you'd see that there is some support, kind of in that maybe $40 area. It's close enough to that point that we're starting to accumulate it. Your downside is that it hits the old lows, which were around $40, but so there's some, we believe that it has a decent enough opportunity that it could bounce up to 55-ish eventually. So we've done a leg in, we leg in. We don't just, yay and put all our money in it. We buy pieces of 2% at a time.
Okay.
So we think there's some upside to it. We think there's a bounce eventually. In the meantime, we collect a dividend. So this one we might hold for a year as we wait and collect a dividend. If it doesn't work out, we know where we're going to sell. If it cracks 40, we're out. So we know our downside, we know our upside, and we know we got a dividend in the meantime.
Maybe we could put up a 5-year chart here. I'm just curious for, say, Royal Bank, ROI. I mean, the bluest of blue chips in Canada, arguably. I'm just curious, what does that picture say to you?
All right. So I literally just recorded on Tuesday a video on the banks. So you want to see all the banks. I went through all the charts, every single one of them.
And it's at Value Trends.
Value Trends website.
Okay,
and it'll be posted, by the way, probably next week, because we usually record 1 week and post the following.
Sure.
But the banks mostly look the same. And in fact, if you look at like an ETF, like the BMO equal weight one, it looks like the Royal Bank chart, okay? There's a couple of them that look different, Canadian Western and Laurentian, but they all kind of look like the Royal Bank, which is, there was an old support level, and then it broke. And so I don't like Royal Bank, I don't like CIBC, I don't like Bank of Nova Scotia, I don't like Bank Montreal. They all kind of look the same, okay? They're broken down. I think there's more pain to come, or at best, sort of a consolidation. But I don't see much upside in the near term for the Canadian banks, with the exception of a couple of them. So TD looks a little different.
Oh, maybe we could try a 5-year chart for TD.
So we bought TD because we're looking for. You see how it didn't break? Like it's struggling for sure, but we think it might just pop short term. Maybe $88 or something. We're just trading this. Like, this is not a buy and hold. We're just in and out. So we don't mind TD. We do own it, but we're looking at Canadian Western Bank. Now we don't own it. Okay?
CWB. You're looking at it?
Yeah.
Okay.
So there's certain banks that look okay, but the group does not. So if the bigger banks mostly look the same, TD is a bit of an exception within the big group. And Canadian Western and Laurentian have different patterns than the big banks. I like Canadian Western as a potential buy.
Keith, thank you very much indeed.
Great to be here.
Keith Richards has been our guest. Thank you very much indeed for watching Market Call this week. Have a wonderful weekend.